Hey there, everybody. Thomas with Basecamp Trading. It is Thursday, March 4th, and we're going to take a look here at the S&P. And I'm going to talk about one of the main things I use, one of the biggest indicators I use to determine when to put on hedges and when to go risk on versus risk off. So here recently, the past couple of weeks, we've been risk off, we've been hedged, and it's played out just like we expected, and he's pulled back pretty good. I've been talking about that on Twitter and StockTwits if you follow me there, which if you don't, you should. At Trades with Tom is the ticker. But one of the big things I pay attention to here are weekly price charts, and I watch for weekly divergences using the MQ momentum indicator. So a divergence occurs when we go to a pivot high and then pull back and then put up a new high, but momentum is weaker, or we try to revisit the previous highs with significantly weaker momentum. So here you can see I just outlined three of the most recent divergences here. We had high number 1, and then 2 weeks ago we had another high. And you can see on the momentum we had lower high indicator lines and lower high histograms in between those two peaks. It triggered the bearish divergence on the break of the previous weekly low, and then our support level would be a test of the swing lows down here. So far it's played out decently. I'm starting to scale out of most of my hedges, and once we get confirmation that this is going to turn back around, then we'll look to go long the market as a whole again. You can see the last one happened back here in October. We had high number 1, high number 2, pulled right back down just about to the previous pivot low, and then turned around and rocketed higher. And then you can see leading into the sell-off we had in the beginning of 2020, same thing, a divergence there. This is why we were actually short the NASDAQ the week before it just started to collapse. And that played out really, really well. Now, if you go back even further, you can see the same thing happening even further back. And all throughout time, you can see a bunch of different times this has occurred. Now, it doesn't always lead to a full-blown sell-off. For example, back here, this is in April, May of 2017. You see we had a divergence where we went higher highs with lower high momentum, and it pulled back, then reversed back up, forming a doji. And as soon as it breaks a previous weekly high like this, after forming something like a doji pattern, you can see how our momentum shifted back to bullish, and we went right back into trending up again. But either way, again, one of the biggest things I look for reversals and to know when to go risk on and risk off is the weekly momentum, and I watch divergences on the S&P E-mini futures as well as the NASDAQ futures. So keep an eye out for it. It's a great way to determine when markets are going to be due for a pullback. It doesn't happen before every retracement. Nothing's 100%, but I would argue it happens at least 50–60% of the time. We get those divergences, then the reversal. So keep an eye out for it. That's it for today, though. I'll see you in the next one. And until next time, everybody, happy trading.